Hello, welcome back. This is going to be a review video on the past 11 weeks, I think, around there, um, of the strategy's performance, and kind of explaining the different metrics used to analyze it. The first half of the video is kind of going to be about more on the last video, where it's the total performance compared to other indexes and stuff, and the other half is going to be more on like the alpha, beta, Sharpe ratios, and all those different methods to look at it. And yeah, so let's get on with it. So this is kind of the total performance graph. We did quite well over here. This is like a very good period. Over here was kind of stable, but also like SPY was kind of weird over here. And then over here was kind of part that stands out. In this part, so basically I started off with the decision. So my portfolio is basically split up in 65, 35%. 65% now is always hold SPY, so that's our beta. I have 0.65 beta always. I'll later get onto what beta is. And so in this case, over here, I decided, I can either have cash, which would be 0, or 0 beta, or I can have SPY. And then here I decided to add the short option, so this would add negative 0.65 beta. And it didn't go too well. And now here I just have it holding, and to be honest, that's done well, and I think I'll leave it like that. I don't think 1.5. I already have enough decision making on that 35% edge that I have, so it's very. I'm right at the moment. I'm just gonna leave it as is with the 65% hold. But really, the important part is that over here, it was doing well with the holding cash, and then here it did bad with the short, and then here the holding, just the hold did well. So I don't really expect this to occur again. However, it can happen, but I think it's highly unlikely. Here we have with the dollar compounded graph. So this is a little bit important in that we can have, if we have losses, well, we have to gain more to recover from those losses than what we lost. So here we're compounding over here quite well, and yeah, same structure. Anyway, so here we have NASDAQ. NASDAQ is kind of, in bear periods, it's kind of the easiest one to outperform. You just go low risk. Now in very good bull periods, it's hard because of how it just keeps on going up. Sometimes it just keeps on going up. Doesn't stop. And so really here, kind of, this is kind of what I was saying here is kind of inverse related, but we ended around the exact same. So, looking at this will be like, oh, well, you just performed the exact same as NASDAQ, and the standard deviations were compared to NASDAQ is almost the same. But the important part is that 35% is being actively managed. And so let's say we're in a bear period. The idea is that, well, we can minimize risk in those periods and continue having the gains of a good period. And so what I want to see is now I have proved really that I can follow a good period. This is still outperforming SPY by 2%, but I followed a good bull period. I kind of want to see now a bear period, and now really I kind of seen a little bit of that this last month, from the 6th to now the 20 something. The 20 today is the 23rd, and so we kind of had the Fed meeting there, and the Fed meeting I did a good profit, and now we're outperforming NASDAQ by quite a bit. So that's kind of what I mean in that when there's bad periods, we don't really have to lose as much. We could even gain in certain cases, and so that's kind of the benefit of having that 35% edge that's being actively managed. So yeah, so we outperformed 50% of the days. 8.8 our overall after expenses was 8.86, and then NASDAQ was just slightly above, basically the same. SPY a little bit more calmed here, but still going up steadily. We outperformed it by 2%. You can see here it's a little bit more volatile compared to SPY. Kind of the moves are a little bit more drastic, but still similar. SPY standard deviation is around 0.7, I think. It'll come up later in the slides. Ours is around 0.9, 5 around, I think. Will come up later, but having the extra standard deviation is kind of part of the point of having that extra return in a good market. And so here we gained more than 2% more, which I wanted to beat SPY, and in the end we did. So that's great. This is the only bad part really. If this part would have just been neutral, it would have been great. But yeah. So 50% of days outperform SPY, and then we outperformed by more than 2%, so that's great. Dow Jones was a weird one this time. After the election, it did incredibly well, and now kind of this month it's done horrible. It's one of the worst. It's down back here, I think, in this range, and really over here just kept on, did incredible gains over here. One of like the best runs in a long time. And in the end, we were underperforming it for quite some time, and in the end we remained above, and now we are completely above it. I think we're outperforming it by 4%, and it's all the way down here. So that's what I mean by the benefit. Well, someone might have said, well, I could have just held it here and would have had less risk, but now it's all the way down here, and we're still up here. So that's kind of the point. And that doesn't mean it'll always happen, but in this case, that's what I expect to happen. So here we outperformed 51.9, so a bit more than 50%, and outperformed by more than 2%. Here's a comparison to all. Yellow is NASDAQ, green is SPY, blue is Dow, and kind of it starts off over here, we're outperforming quite well in this weird bad period. Then we recover from it, we're doing quite good, stay in the middle. Election happens, don't catch the train. I was actually a bit more short on it. And then I got some losses in there, but then quickly we gained. We pretty much gained. We went back to NASDAQ levels after the fall, kind of retraced a little, and then we kind of just went with the flow after that and just went up. So quite good. Over here, I gained some good market efficiencies in other markets that weren't present in NASDAQ and SPY, so I gained a lot there, and then kind of just kept it up here. So my goal here for daily percent gain, this is the average expected gain in one day. My daily average expected was 0.717, which is quite a lot. And right now we ended at 0.16, so I'm happy with that after expenses, so I'm quite good. Over here we have a positive trend line, which is the important part. Really, it's kind of mostly in the middle, some very good days, some good days, some bad days over here, but overall we have positive trend line, which is what I wanted, and close to 0.17, which is great. Green days, so 61% of days were profitable. Around 50% of these days outperforms SPY, and I think this is a good number. I mean, I expect to get it higher over time, but right now we're doing well. 60% profitable trades. So here we get into the beta section. So beta is basically your risk compared to the S&P. So if you held a SPY ETF, that would be a beta of exactly 1. And so let's say you want to, let's say you're holding a leveraged 2x SPY, and that means you would have a beta of 2. Now if you're holding an inverse, that means of SPY, a 1x inverse, you would be -1. Now the important part in this is that my beta, let's say I have really 2 case scenarios, either bear or bull. If I'm going bear, which I've gone around 95% of the time, which is basically almost all the gains have been from bears, my beta is around -1.17. Now if you're going -1.17 long term, that's not going to go well, right? That's a -1x, and markets normally tend to go up. Now the point here is that, let's say you're holding, because I'm always holding 0.65 beta, so and say in one day it goes up by 0.5%, so I would be, I wouldn't be at 0.5% because I'm not on beta, I'd be a little bit below. Now that 0.35% that I'm diversifying into other stuff, normally that's into bear trends. Let's say I gain in a bear trend that lasts, I don't know, maybe 2 days. In those days, well, I can have a gain of maybe 0.4 and then be 0.9 over maybe around 0. Because you have to take into account it's only 65% and it's only 35%. So, around 0.6, 0.7. Compared to 0.5 on SPY, that would be a good case. Sometimes it can go inverse to you, and then you end up still profitable that day, but you didn't outperform by just a little. That's happened quite a bit. Or you're just neutral. That also happens. Or negative. Now negative is the red days. Those do happen. Now it's important to control your losses there, and that's why my gains and losses are almost exactly the same for the averages, which comes in later. But the point here is that if I'm going bear, just take this -1.1 is not really long term. It's more a short-term thing, which can either last minutes or maximum of around 5 days, not too long. Now here, what I mean by positive beta here is that let's say I go bull. So if I go bull, then the 0.65 adds on to the bull leverage stuff, the other 35%. And so that goes up to 2.36. So this is quite high risk that overall it's a portfolio. Now think about it like this is not being a long-term thing. What I said before is that this is really going in only for short periods. And so, and right now if I would have gone 2.36 overall beta, well, in a bull market that does well, but overall time period, the losses start to eat up all your gains, and then you're basically neutral. So that's why you don't really want to hold long-term leverage ETFs, because you kind of, if you get in at the right time and you leave at the right time, they're great. But if you don't, then it can basically lead you to underperform the market, and you have a lot more risk. But right now I'm using them at an advantage, so I think we're doing quite well. So here's the alpha. This is taking into consideration the negative beta, which I basically always used. So the alpha is basically your difference between what an asset return and what its benchmark return. So kind of saying, okay, well, how much did you do compared to the market? And you want a positive alpha. And so here you have your return, your risk-free return, your beta, which was from before the negative value, your return of the market, and then your risk-free return. And when you compute this, we get an alpha of 0.15. So that's quite good. It kind of makes sense in that, oh, well, your beta is negative, but you're still outperforming by 2%, so you're doing quite well. Now, if we use the positive beta value, we get a negative alpha, which makes sense because you have a 2.36, but you only outperform by 2%. It doesn't make much sense. And so that's why most of the time I was on the bear. So here we have a positive alpha for the negative beta. If I would have mostly used the bull, then that depends. In a bull market, maybe it would have been higher. But for this 3-month time period, I didn't really find the strategy didn't really find that many good bull opportunities. So I kind of was just in bears. Now my max loss was negative 3.32, and then my max gain was 3.47. So they're similar. Now these are extremes. I think the next closest values is around the 2%. So they're kind of extreme, but just taking into account that they could happen, but they're quite rare. Here's the Sharpe ratio. So your Sharpe ratio is kind of using the standard deviation, and where the alpha did not use the standard deviation. And so here you kind of have the standard deviation into play with the division. You have your return with your asset, and then your risk-free return divided by your standard deviation. So when we get that, we have the constant. So what I mean here is that you have your current. So these are the 50-something days, I think around 54 of the market. So the market had a Sharpe in this time period of 1.18. It's only this period. On the next slide, I'll show the estimated yearly, and then mine was around 1.12. So we're underperforming by 5%. And I think that's quite well. I mean, considering such a very good period we've had, and only underperforming by 5%, that's really well. Now, if we go over on the yearly, we have an estimated Sharpe of 2.43, so that's very good. Now the market for this would be 2.55, which already has greatly this value 2.55. This has greatly decreased after the whole Fed meeting and everything. So that's why what I kind of meant was that the other thing, due to having the actively managed part, it's expected not to lose as much and keep on to the gains. And so the expected yearly market ratio here, 2.55, 2.43. They're already having a 2.43 expected Sharpe is very good. It's considered excellent. So I'm trying to keep it there. Right now, it's actually even gone up to 2.53 this next month. So even doing better. Information ratio, right now it's kind of irrelevant because really this kind of matters at the end of the year fund's performance. So, but really I kind of just have this as 1% more than the current S&P 500 return. This is very kind of subjective in a way. Might change this metric, but we still have a positive value as we outperform by 2%. But it's quite low due to only in a whole year, if you only outperform by 2%, it's kind of depends on the market condition, but at the moment it's not super high, and probably at the end of the year it'll be outperforming by a lot more than that. most likely. I mean, we are already outperforming. Dow Jones was 4. I think SPY is around a 3 or something. So we're still even in 3 months at 2%. So imagine what happens in a year. That's what time will say. Yeah. So the fees of the fund are only 0.05%. So that's quite good. That's how much fees like kind of eat up of the gains and how much money is in there. So it's a low fee amount. Expectancy ratio. So here I kind of just put like how many days I would win. So that 67% number, I think it was, times the average win amount, which is 0.7, I think, and then minus the losses for that in comparison. And we have a positive value, so that's quite good. So this is kind of expected in the long term what's going to happen. This does not have standard deviation to account, so that's important to note, but you kind of just want a positive value too. So here, I never really showed this graph, but here's kind of like all the ETFs that I've gone into and how many I have positive or negative trades from. And the most important one is this one. This is the one I've mostly gone into. You can see it's around 66.7, which is basically how many trades have been profitable. It's close to the same amount. So, all these values you can see are above 50%, so that's kind of where I wanted to be. But yeah. So here we have the idea would be that, let's say someone just held the ETFs that I've gone into, just held them over a period of time, right? And would have had the same diversification. So you still have your 65% SPY, but the 35% is the same thing, what I've been trading, but just holding it, not going in every day and out. And so you can see in both of the cases, if you go into the bull version of the ETF, it's negative 13%. This isn't a good year. So that's the problem with leverage. It's very bad. If you want to hold for these weird periods, it's not good. If you want to go into the bear one, which is the one I've mostly gone into, negative 1.29. This is clearly the better option. Now SPY is at 6%. So this is still not good. Now you can see from a negative 1.29%, actually, my bad. This is 100% of the ETF holding. Later on, I'll show the diversified version, but this is 100%. So the 100% is negative 1.29. The diversified version, you would end up at a 3.12. So this would be underperforming by a half of SPY. And we ended up at around 8. So you can see how much, how having going in and out actually helps a lot at keeping SPY's gains and earning more. So yeah, that's kind of the important part. If you would have just held it, you would have actually in the negative. If you only would have held the ETF, and if you would have held SPY with it, those would be your only gains, which would lead you to 3.12. So, and this is also assuming that you pick the right ETF to hold on to. It's kind of weird where you have SPY, and then you're holding on to a bear ETF, which is kind of weird, which is kind of counterintuitive. And that would be the correct option. If not, you would have been really bad. You would negative 12.8, and then you have 6% gain on SPY, so it'd be around negative 10 around there, probably negative 9, that range. So yeah, it would have been like a weird thing, but it's not advised to just hold those ETFs long term. That's why I kind of just use the benefit of using them only in a short period amount of time, so either ranging from minutes to like a couple of days, not very long. And so here we can see we outperformed the bear hold, which would have been what normally someone would have just held 184%, so more than that. The mean ETF, so this is accounting for the diversification, would be 1.36, and the losses would be negative 109. So, and ours are actually 0.71, negative 0.7. So our gains are higher than our losses barely, but we're still our risk management is very well in comparison to just holding them. If you would have just held them, this is with SPY into the into the portfolio, you still would have had a 3.6 and a 0.9 over here in the ones. So that's not good. It's very volatile, and we decreased that by a lot. You can see we decreased the gain, sadly. Well, I mean, kind of expected, by 48%, but our losses decreased by 55 or almost 56%. So, we decreased our losses more than we decreased our gains. So that's good. That's kind of what I wanted to see. Our standard deviation is 0.96, which is almost the same to NASDAQ's, which is I think 9.8. The standard deviation, if you would have just held, is 1.6. So that's kind of what I mean by the risk management, and that it was a lot better than just holding them. So we have 40% less risk. So here we're comparing it finally to the S&P 500. So S&P did not do better than its losses, barely, almost the same. The standard deviation was less, 6.7, so around 0.3. So here we have kind of this mean thing. This is kind of just saying like how much are you winning and losing in respect to the market, and you can see we are winning and losing better than it. Our management of risk and losses and gains is better than the market. Now this wouldn't take into consideration, let's say, if you have like a 2x factor into here, because it would just get divided, and so that's where standard deviation comes into play. And we could still lose a little bit more, and we could still gain a little bit less, so we have a good range. And so mean transactions is a 1.93. I thought, okay, so the standard deviation for us is around, right, 0.96, and the market is 0.67, I think. And so, yeah, 67. So let's see, our standard deviation was 0.96. Let's compare 0.96. Yep. So, we still have that higher standard deviation, kind of expected. If you want to earn more, you have to have a bit more risk. And I think we do have more risk in that, but we're still managing it correctly, so that's good. We're managing it even better than the market, so that's quite good. Yeah. So mean transactions 1.93, mean day trade 0.7. So this is what I mean, where it's 3.5 days a week around there. So they're not lasting very long, these trades. And then the overall is 8.864%. So I think really that, to be honest, right now, the month of December, we've done quite well, hitting a new all-time high of 10.6%, and the market's not doing as well. It's falling quite a bit from there, and now it's kind of recovering. But I think right now it's done quite well. Having that active managed part is a benefit in comparing to just holding. You do have the cons would be that you do have more risk than SPY, and I need to have a larger time frame to see how well it actually performs, but the point is that you're being actively managed and hedging against the losses, and the idea is that it's expected to lose less when it falls, and still try to catch those gains. But we'll see that in the time to come, and I think that's probably what's going to happen at the moment. That's what it's indicating from this month of December and these past 3 months too. So let's see. I think it's done quite well, and hope you're here for the journey. So, see ya.